Good afternoon and good morning, and thank you for joining our webinar today. I'm Jeff Richardson, Senior Vice President for Marketing and Communications at VantageScore, and I'll be your host today. Today, we're discussing one of the most important developments to impact the consumer credit industry, which are programs aimed to provide relief and assistance to student loan borrowers. And we're pleased to have join us today experts on the subject, including those from the Department of Education, from VantageScore, as well as from the three national credit reporting companies. I'll make formal introductions of our speakers in just a few minutes. Perhaps stating the obvious, the $1.7 trillion student loan marketplace is undergoing unprecedented reforms. And among those changes is a program known as Fresh Start, which aims to help some 7.5 million eligible student loan borrowers that are in default. And today we're going to hear from a special guest, Patrick Campbell from the Department of Education, who will provide an overview of that program. We'll move on from there and hear from Dr. Ricard Vandenboe from VantageScore. He's Executive Vice President and Chief Product Officer, and he's going to explain how these changes to the reporting of the eligible loans and debt forgiveness could impact VantageScore credit scores. And then we're pleased to be joined by subject matter experts from all three national credit reporting companies. From Equifax, we'll be joined by Tom O'Neill. From TransUnion, we'll hear from Jessica Harmon, and from Experian, we'll be joined by Kathleen Malley. And we're going to have a panel discussion to tackle some of the broader implications from these changes. And before we get to that, just a little housekeeping. So here's a little bit of information about today's program and our participants. I'm going to pause here for a couple seconds to allow webinar attendees to read this information. And as you do, I'll just mention that we will share our slides and a playback of this webinar to all those who registered, and we'll send that to everyone's email once it's available. So I'll just pause a couple more seconds. Okay, thank you for that. Now I want to just share a little bit of information about VantageScore for those who have limited awareness about who we are. VantageScore is one of the two primary credit score model developers in the United States. And we've pioneered and been first to market among tri-bureau models on a number of important innovations. We were the first tri-bureau model to actually incorporate rent and utility information into scoring models when that data is reported to the credit files. And we've introduced much needed consumer and lender transparency by writing reason codes in consumer-friendly language, and then even adding explanations and tips to help people improve their scores. We also perform model performance assessments on an annual basis. And we actually put all of that information and performance evaluation data on our website for anyone to read. VantageScore was the first to eliminate paid collection accounts. And more recently, we announced we'd no longer use any medical collection account in people's scores. And with our most recent model, VantageScore 4.0, we incorporated trended data. So trended data looks at a consumer's credit behavior over a period of time instead of a point in time, which provides a much better assessment of their risk. And we're really proud to be a leader in our industry, both in terms of innovation and attentiveness to the needs of consumers and lenders. And what we're finding is that approach is paying off and winning us considerable gains in the marketplace. Based on a recent analysis performed by global management consultant Oliver Wyman, we now have about 3,000 companies using our scores, including 9 of the top 10 largest banks, many of the leading fintechs. Basically, lenders of all shapes and sizes use our scores, and our usage during the period that Oliver Wyman measured it grew by over 18%. Our growth and innovation is extremely energizing, and we're really excited to play a major role in the consumer lending marketplace. And speaking of which, we're going to tackle one of the marketplace's most timely and relevant issues, which are student loan reforms, and we'll be joined by Patrick Campbell, who I'm really pleased to introduce. So Patrick works as the Executive Director for Vendor Oversight and Program Accountability within the Federal Student Aid Office of the Department of Education. That stands for VOPA. VOPA helps ensure FSA provides world-class customer service by identifying potential pain points throughout the student experience and then working across the FSA enterprise to address those issues. And before that, Patrick actually was with the CFPB. Patrick is going to provide us an overview of the Fresh Start program and then hang with us for a little while after that. Patrick, thank you so much for joining us, and I'll turn the webinar over to you at this point.
Thank you very much. I really appreciate it. Things are a little busy over at Federal Student Aid right now. We have a lot going on. We have the Fresh Start program. We obviously have the bigger debt relief program that was announced by the Biden administration about almost a month ago, and returning to repayment at the end of this year. So yeah, we have a lot going on. I do want to focus as much as we can today on the Fresh Start program itself. If people do have questions about generalized debt relief, I can put a link to the latest FAQs. We just actually updated a couple in the last 30 minutes. And so if people, if they have questions there, we can direct you that way. So let's talk a little bit about Fresh Start. What we're showing right here is what we call the Fresh Start fact sheet. So everything I'm going to be talking about today is going to be on this fact sheet. So again, you don't have to take notes. But basically, in April, the department announced that it would eliminate the negative effects of default for borrowers with defaulted student loans. As Jeff said, that's about 7.5 million borrowers with defaulted federal student loans who are going to return to repayment and basically be made current. These borrowers are disproportionately first generation, have received Pell Grants, and would otherwise qualify for low monthly payments under affordable plans like income-driven repayment. So I'm going to go through these little circles right here, talk a little bit about what the program does, who is eligible for program, how long the program will last, and then I will dig deeper into the credit reporting part of it, just because I know that this group probably cares deeply about that. So as you all know, people who are who currently have defaulted federal student loans are reported to the credit bureaus in a collection status. They generally do not have access to affordable repayment options, and they are no longer eligible to receive federal student aid to complete their education. They are usually, not right now, but they are usually subject to involuntary collection efforts like wage garnishment or treasury offset of their government benefits. And to rehabilitate those loans, they have to sign a rehabilitation agreement and make 9 out of 10 on-time payments in order to be transferred out of default. Fresh Start basically turns a lot of that on its head. The first thing it does is it allows borrowers to have sort of almost one-step immediate access to affordable repayment options. A borrower who chooses, so we'll just start, everyone gets Fresh Start benefits. So all 7.5 million borrowers get Fresh Start benefits, but borrowers who choose to access one of these affordable repayment plans can raise their hand, and then they will be basically transferred over to a non-default servicer, and then they will have access to income-driven repayment plans, which could have payments as low as $0 and still be current. That would also allow them to possibly be eligible for public service loan forgiveness or forgiveness under income-driven repayment plans. So it's a pretty good deal, but borrowers will have to raise their hands to do that. And generally, the Fresh Start program is going to last a year from the end of the payment pause. The payment pause has been moved many times, but I think we're at the point where it's going to probably be definitively ending on December 31st, 2022. So that means borrowers will have until December 31st, 2023 to raise their hands and be transferred over from our default loan servicer to the non-default loan servicers and have access to all those plans. Additionally, if a borrower wants to complete their education, they are now eligible to go back to school and receive federal Pell Grants or federal student loans. We have issued a Dear Colleague letter to our schools explaining what paperwork they need to fill out, but essentially borrowers can go back and complete their education. We have also announced that borrowers during this Fresh Start period, so from now until December 2023, will not be subject to involuntary collection. So they will not be receiving collection calls. They will not be subject to wage garnishment or treasury offset until no earlier than January 2024. Lastly is generally when people rehabilitate their loans, their defaulted loans, they can only do it once. What we are saying is this one-step rehabilitation doesn't count against that. And if anyone has rehabilitated since the payment pause, which was March 2020, borrowers have been under a payment, as most of you know, borrowers have not had to make any payments on their federal student loans since March 2020. If they have rehabilitated since then, that will not count against them either. So those are the big ones that don't involve credit reporting. The next part is we'll get into the credit reporting features. Let's just scroll down and make sure I got my notes here. We'll get into the credit reporting features. Let me push pause there. Let's talk a little bit about what type of loans qualify and what loans do not qualify. So pretty much most federal student loans qualify. Any direct loans, those are loans that are made by the department after 2008, generally after 2008. Defaulted FFEL loans, those are federal family education loans. Those loans are also eligible. And then defaulted Perkins loans, these are school generated loans that are held by the department. And again, this is all in the fact sheet that, I think I put a link in the chat for everyone. Loans that are not eligible for Fresh Start are school held Perkins. So these are Perkins loans that are held by schools. HEAL loans, these are health education loan program loans. There are not very many of those. Loans that have been assigned to the Department of Justice. These are ones that have judgments against them. Loans that defaulted after the payment pause are not eligible for Fresh Start because the department has argued that those people shouldn't have defaulted in the first place. So while those people are not eligible for Fresh Start, the default should be removed and they'll be returned to a non-default status as if they were never in default in the first place. As I said before, this program is going to last for a year, and borrowers have a year to raise their hand and be transferred to a non-default servicer, starting from the end of the payment pause. Okay, so let's get into the part you all really care about, and that's the credit reporting features. So generally, as I'm explaining this to a group of experts, but as you all know, generally under the Fair Credit Reporting Act, loans that have been delinquent for more than 7 years generally do not appear on credit reports. We don't want any loans that are not currently showing up on a borrower's credit report to magically start showing up on a credit report. So the first thing that we're going to do is, of the 7.5 million borrowers who are in default, any loan that has a first date of delinquency greater than 7 years, we're just going to delete that trade line. They don't show up on the credit reports now, and we want to ensure in perpetuity that they don't show up in the future. So I would say about half, this is sort of rough math, about half of the 7.5 million borrowers have been delinquent longer than 7 years. So, we will delete those trade lines we will delete those trade lines and not report them in the future. No matter what that borrower does, if that borrower raises their hand to be transferred to a non-default servicer, we will continue to not report those loans to the credit bureaus. The only caveat to that is if a borrower were to consolidate one of those loans, that will create a new loan, and that new loan will be reported to the credit bureaus. For you, this shouldn't matter all that much because these people don't show up. This stuff doesn't show up on their credit reports now, and it won't show up in the future. So, so that's about the first half. Let's say that's the top half. So everything else that I'm going to talk about applies to the other half, which is people who have been delinquent less than 7 years. So starting when we fully activate Fresh Start, which we are currently looking at December of this year when we get it fully up and running, all the other borrowers will start to be reported not in a collection status, they will be reported in a current status. So they will get moved to from I think it's 62 to a status 11. And they will remain in a current status during the Fresh Start period. Now, if a borrower does not raise their hand or pay off their loans before the end of the Fresh Start period, then at the end, so January 2024, they will basically return to a default status. However, so it'll be sort of like they were just before. However, the first date of delinquency, the date that the original date of delinquency where the default started, will continue to be the same date it was before. So let's say they were started in delinquency in say 2019. When they go current, and then they go in collections again, that 2019 date will persist. So we will not be resetting the 7-year clock for those borrowers. Now, if a borrower does raise their hand and get transferred to a non-default servicer, it is our general practice under rehabilitations to delete the collection reporting. That is something we do irregardless of Fresh Start, and a new loan will be started by the non-default servicer, just like in a normal rehabilitation. The only difference is that if that borrower at the non-default servicer does go delinquent again, we will maintain the original first date of delinquency. So like I said, that 2019 will persist. So I do understand that means, what you will see is a date open, let's say a loan that is open sometime in probably 2023 with a first date of delinquency in 2019. That's actually how our current default loans look. The date open is much after at least a year after the first date of delinquency hits. So again, you'll see we spend a lot of effort making sure that we are not re-aging these loans. So anyone who has at the start of this program who is greater than 7 years, we're not going to report them. We're going to delete those trade lines. Anyone less than 7 years, they're going to be reported as current. But if they do go delinquent again, either by redefaulting and or going delinquent, we are going to maintain that first date of delinquency. Lastly, we have already implemented this, that we have removed the ED reported defaults that are to the CAVER system. Don't ask me to explain what that acronym means, but it is the Department of Housing and Urban Development's record of defaults. So we have removed the CAVER's notifications that were submitted by the Department of Education. So just one more time, we have done the CAVER's reporting now. We will be implementing the other credit features and protections starting in December. So for November, for the November period. So in the report that goes out, first week of December, that is when you're going to start seeing the Fresh Start credit reporting in the ecosystem. And think if there's any other parts here that I want to make sure we can cover. Obviously, you'll have some questions. Borrowers who do raise their hand will get transferred to a non-default servicer. We were estimating probably about 45 days. There's a whole lot going on right now, so I'm not sure. Depending on if they do it earlier in the process, it might take a little longer than if they do it a little later in the process when things have sort of settled down with the debt relief, return to repayment, and everything else. But people will be transferred over, and then they will then have access to these other programs. So that is Fresh Start. I look forward to other people's questions and the discussion afterwards. Thanks for the opportunity to talk about it.
Oh, thank you, Patrick. And it's I think it's important that market participants do get a chance to hear it kind of from the source, and we really appreciate you spending some time with us today, and are appreciative that you'll be able to hang out for little questions. As I saw the questions, I think you might have addressed some in the presentation, so we'll just kind of double click and make sure that we revisit some of the questions that they had.
Can I just say one more thing? And I just want to say thank you to Vantage, to the CRAs. I knew nothing about credit reporting when we started about this. I feel like I've had a college course in credit reporting, credit furnishing, and so I really appreciate all the advice and guidance. Doesn't mean we've always agreed on what the outcome was, but it definitely was informed, and I'm really grateful for the advice that we've gotten. So thank you to everyone who led us along the way.
Thanks for saying that, Patrick. And I know that we've certainly appreciated the opportunity to collaborate. So we'll move on to the next section of the webinar. And at this point, we're going to drill down into some analysis that VantageScore has done to better understand what these changes mean to consumer credit scores. And so we're going to be joined by my colleague, Dr. Ricard Vandebo, who serves as our Executive Vice President and Chief Product Officer. And some quick background on Ricard. Ricard has spent 20 years as a product leader and general manager, working at the intersection between financial services and quantitative and qualitative data analytics. So most recently, he served as Chief Product Officer at Unicast, which is a location data company. And he helped steer a more project-driven strategy there during a period of that company's incredible growth. And among his previous other roles, he was a product leader at data analytics company, including Bursin by Deloitte, Seven Park Data, which is a Vista Equity Partners company, a real estate analytics company, Marker. And early in his career, he led analytics advisory teams at First Data, which of course is now Fiserv, where he shared insights on consumer spending, financial services, retail and small business sectors as their chief economist. So I shortened your amazing credentials, and I'm done embarrassing you, Ricard. Over to you.
Thank you, and definitely embarrassed, but thank you, Jeff. And again, thank you, Patrick. It has been a great collaboration that we've had with the Department of Education, and we've really appreciated the openness for dialogue, and on our side, it's been great. So when we heard about Fresh Start and these other changes to student loan programs, obviously we realized that it was going to have an impact on those loan holders and their credit scores. So we invested quite a bit of time to investigate and run simulations so we could get an understanding of what the potential impact could be. Obviously, we shared a lot of our insights with the Department of Education and the bureaus, and now we've shared it also online on our website, but we thought having a webinar would be the best way also to continue as part of this education process. Also, just want to say a big shout out to our phenomenal data science team, who are the ones who prepared this. And in all honesty, I'm quite humbled to present their work today. With that, then, I just want to, the key point of what we're trying to do here is obviously to help everyone here understand what is this potential impact of these different student loan changes and programs that they'll have on consumers, both in sort of the near immediate term, but also in the more medium term. And I think before we go into this, though, it's important to understand sort of how it is that student loans are treated by VantageScore models already. So as you can see on this slide here, yep, we do use student loans as part of our scoring models across all the 4 models that we have out. Caveat, we aren't able ourselves to separate between federal and non-federal loans, but, the analysis we've done, therefore, has been treating them sort of in a similar manner. They are included as part of installment type product attributes. So there we look at payment history and the amounts paid down, the age, the number, and those types of pieces. We also include them in the overall account attributes. And again, here we look at the payment history, amounts that are paid down, age, and also the wallet composition. And for our more recent, and those that obviously the most predominantly used models, version 3 and 4, we did create student loan specific attributes. And there we are again using the payment history and the amounts that have been paid down. And the difference also with version 4 is that we including them also in the installment in the trended attributes, where we're looking at the history of balances and payments as well. So with that, let's now just have a look at the different student loan changes and the findings that we had here. So you'll see that as Patrick also mentioned, there are 3 sort of high-level changes, and these were the 3 that we ran our simulations for. First of all, Fresh Start, which we've obviously had quite an overview of now. Secondly, the debt forgiveness program that was announced, I think it was just about the 24th of August or so, and then the end of payment forbearance, which I think most of us are understanding will come to an end now at the end of the year. So let's start then and dive into the impacts that we've observed with the Fresh Start program. So there are actually quite a few different scenarios, and we need to actually talk about each one. So obviously, as Patrick was mentioning earlier, these repayment plans need to be opted in by consumers. So the first thing we're trying to do is to show you the difference between those who do not opt in, both in the near term and in the longer term, and for those who do opt into the programs, again, in the near term and in the longer term. And in the longer term as well, we looked at a few different scenarios, as you can see here in 4.105. So 4 is looking at those in the longer term impact of those that are making payments during the year. 4.1 is looking at those who actually don't have any payments due during the year. And then the fifth area here is those who go back to defaulting during the first year. So those are the 5 different scenarios that we have looked to simulate, and that we are going to share some initial, estimates on terms of how we see them impacting the credit scores going forward. So with that, Jeff, if we can move it forward to the first one. So the first 2 then we're looking at are the immediate impact that you would expect to see with consumers. I'm going to start looking actually at those who do not opt in to the repayment plans and what we expect to see with them. So again, this is defaulted borrowers who don't opt into a repayment plan. And what we'll see here is that the student debt is becoming active again. So that will in turn increase outstanding balances and the balance to loan amount ratios. The trade line will be reported as current paid as agreed and not in collections. However, the previous negative payment history on the account is not removed. So what we then can see is that there will be, depending on the model, some different impacts. If we look at those the scoring on VantageScore 3, we will see that the majority will see an increase here of, in the order of 30 points, but we'll also see around a quarter or so, we estimate to get a decrease, but a pretty negligible decrease of around 15 points. With VantageScore 4, we expect actually to see the majority here in the same scenario, actually seeing a decrease with an average decrease of around about 30 points. So that's the immediate impact, again, of what we expect to see with those that do not opt in to the repayment plan. Let's now have a look at those who do opt in and what we'd expect to see the immediate impact there. So again, this is those who've previously defaulted and but now are opting in to the repayment plan. So what we'll see here is a new trade line is reported under current and paid as agreed. The previous negative payment history is now removed from the trade line, and the previous default service trade line is deleted. So as a result of those actions across both models, we expect to see almost all of the consumers with previous defaults to actually see a positive impact, around about 50 points or so for those who are being scored with 3.0, and around 30 points difference, an increase with VantageScore 4. So that's what we expect to see in the near term. So again, those who haven't done, who have not signed up for the repayment plan, we see a bit of a mixed difference there. Those who are on, if they're scored on VantageScore 3, we'll see a positive impact for most, but those scored on VantageScore 4 will see a negative impact. On those who do join in and opt into the plan, we obviously see a positive impact for the vast majority across both of these scores. Let's now take a step and look at what the impact is for these borrowers over the longer term. So what we've done here is try to understand and simulate what the impact will be roughly in a year's time. So in this first scenario within this group, or scenario number 3 here, we look again at those who are not opting into the repayment plan. Okay, so what we'll expect to see here is a higher percentage of we'll see again here in VantageScore 3 a larger proportion. In fact, most of these will expect to see an increase in their credit scores even a year from now. But on VantageScore 4, just like we saw with the near-term impact, we expect the longer-term impact again. With VantageScore 4, we'll expect to see the majority to see a decrease with VantageScore 4, and we'll expect that decrease to be between 25 and 30 points. Let's now look at the impact of those who are opting in to the plan. So in this first scenario, and this is again about a year from now, those that opt into the repayment plan and those that are making payments now over this year. So for that scenario, we expect to see pretty much all consumers across both models receiving positive impact on their credit scores. On VantageScore 3, we expect that to be, maybe in the 65 to 70 point range, and on VantageScore 4, around about 60 points or so increase as well. So obviously here, very positive effect. Those that have been in default before, who are now signing in for a plan and beginning to make repayments, they're the ones who are going to see the biggest benefit on their long-term, a year from now, on their credit scores. Now let's look at another scenario, which is those that, again, opt in, but don't have a payment due. So for those that don't have a payment due, what do we expect to see their impact to be in a year from now? Well, again, we expect some positive effects here. With VantageScore 3, we see almost all seeing a positive impact on their credit score of around 45 to 50 points or so. With VantageScore 4, we actually get a bit more mixed here. We see, obviously, the vast majority seeing, we see here, let me rephrase that. We see about just under half, we expect to see an increase in credit score of around 20 points or so. And just under half, again, we expect to see a decrease of about 20 points or so. So it's a bit mixed here, and the scoring increase or decrease will depend on other factors that are on their credit files. Let's now look at the final scenario for Fresh Start, which is those that do opt in, but however, default on their repayments during the first year. So what we see here, hopefully not surprisingly to most of you, is that on both models, we see that almost all we expect to have a decrease in their credit scores. In VantageScore 3, we expect their decrease to be around 60 points, and on VantageScore 4, we expect their decrease to be around 50 points. So again, not too surprising, those who opt in for the program and then default will see a negative effect on their credit scores. So that's in essence what we've seen here. Again, we will be sharing the slides afterwards so that you can have a look at this in more detail. But I now want to quickly have a look at the other student loan programs so I can quickly surmise kind of some of the observations we have here. So obviously the debt forgiveness program, you've probably seen all the headlines and there's a lot of news out here. I'll just be very quick about what the situation is. So obviously this is for borrowers who are eligible for this are those that earn less than 125,000 or 250,000 if they're married. Those that are income eligible will be eligible for a $10,000 relief on their outstanding loans, and those who had Pell Grants would be receiving an additional $10,000, so a total of $20,000 relief on their outstanding debt. Obviously, much of this has already begun for those where there is income information available to the Department of Education, and for those that there isn't, it'll take a bit longer for them to be able to do this. So let's have a quick look then on the next slide on what we expect to see here. So again, we see here, to see some impact as a result of this on their credit scores. So on VantageScore 3, you can see here that the majority here of almost 80% to either have no change or a positive change as a result of this, with maybe a fifth or so having a potential decrease in score. And on VantageScore 4, we actually see that around 90% would have no change or a positive or an increase as a result of this change. So all in all, though, you can just, again, an understanding of what the impacts then will be for the debt forgiveness program. Now, the final change that's happening to the student loans is the end of payment forbearance. So obviously, back in March of 2020, as Patrick mentioned, the government began not requiring borrowers to continue their student loan repayments, and the vast majority did use the opportunity to not continue those. But we do see an estimate here of about 18 to 20% or so of borrowers, in other words, 8 to 9 million, having made at least one payment during this period of this pause period over the last 2 years. So with this, we do expect to see, potentially some increases during the extended payment pause, and obviously until the end of the year. However, when the payment pause ends on the 1st of January, and we see consumers beginning to be required to make payments now on their loans, on their student loans, we see that that's probably when things will begin to change, right? Now, obviously, as we've seen before, there are lots of programs available, but there may well be still many borrowers who don't opt into those programs and may not have the means, or may not have potentially even the deposit set up properly, and other things that can happen, right? With, they may have changed their checking account, or various other things could have happened that means that their auto payments don't restart naturally. So what we may then see is that there is a non-substantial portion of lenders who, with the end of forbearance, may see some missed payments as a result of that. And obviously would expect to see that that would then have a negative impact on the credit scores of those individuals. So next we have a quick summary. I won't spend too long, so we can hand over to the other panelists. But again, we expect to see here some of our VantageScore scores to be impacted for the borrowers who are impacted by this, to experience a little bit of volatility in the near term from some of these programs. We do expect to see some declines as forbearance ends, just simply because, as I mentioned before, there is likely to be now a number of these borrowers who, either through technical reasons or for financial reasons, do not start making their repayments on time, and that will depress, obviously, the scores of those who are affected by that. But we do expect to see a lot of these fluctuations to stabilize by, halfway through to the end of next year.
Thank you, Ricard. That was a lot of information, and really appreciate you and your team working on these simulations. And should mention that, these simulations were based on information that's been made public, that we had at the time. There's also just sort of the reality that everyone's credit file is reflective of their own information in their credit scores are reflective in their credit files, and so everyone's situation will be somewhat different. So these findings should be treated directionally, but certainly insightful. Ricard, really appreciate you and the team pulling that together. So Patrick, I'd like to ask you to join us and ask a couple of questions. Like I said, I think you touched on some of these things, but we'll just double click on them so that the audience certainly understands some of their questions. So timing, I think you said there was maybe a couple points in time where there's perhaps milestones that are going to take place. So what's the timing of the Fresh Start operations?
So we are rolling out benefits as they come. So as of right now, the CAVERS notification has been removed. Borrowers can start going back to school and receiving federal aid now. The credit reporting features will, generally will take effect December. And then borrowers have until a year after the payment pause ends, which is December 31st, 2023, to raise their hand and be transferred to a non-default servicer. It's basically like a one-step rehab.
Gotcha. Anything else you wanted to add to that? I didn't mean to cut you off.
No, you're good.
Volume of borrowers impacted, I think I might have mentioned it. I think I threw out the number 7.5 million. Can you give us a sense of the volume and kind of what the profile definition is?
Yeah, I mean, so 7.5 million borrowers are eligible for Fresh Start. As I said, in real rough math, about half of them, for credit reporting purposes, have been delinquent for more than 7 years. So those folks, you don't see them now, you're not going to see them later. So there will be about 3.5 million borrowers that will be, like I said, real rough math, about 3.5 million borrowers that will be affected. by at least the downstream credit reporting changes that we are going to make.
Thank you for that detail. Income-driven repayment plans. How essentially will those work? And then this is kind of interesting. What consumers might expect $0 monthly payments?
So I am not, just to be clear, I'm not talking about the president's recently announced changes to the income-driven repayment plan. We currently have, I forget, like an obscene number of different types of income-driven repayment plans. But basically, borrowers who don't have defaulted loans, who are in a non-default status, are able to enroll in an income-driven repayment plan. And depending on which one of them you are, it's some percentage of the poverty line, 150%-ish. Those people who make below that adjusted gross income are able to get a monthly payment of $0. So even though they have a $0 payment, they are still considered current for credit reporting and other purposes. So there is some discussion about creating a new income-driven repayment plan. I can say I definitively don't know anything more than what was in the generalized debt relief announcement, but generally borrowers can enroll. Like I said earlier, that borrowers who raise their hand, it was going to be on average about 45 days to get transferred over to a non-default servicer. I'm not, given everything else that's going on, I'm not. Please don't hold us to that. We imagine it'll probably take a little bit longer.
Certainly, it seems like some of this it can and will evolve as we go. So Ricard, a question for you before we move on to the panel. So you mentioned some differences between the impact for VantageScore 3.0 scores and 4.0 scores. Can you just provide a little bit of color and clarity around that?
Yeah, of course, every model has a slightly different way that they work, and as a result, you might see different results. The main driver of the differences that we're seeing here between version 3 and version 4 is that to really improve the predictive performance when we created version 4, we use a trended data. So what that means is that we're not just using that one snapshot in time of the credit file at the time that the credit number score is pulled, but we're actually looking at trends over time. And so as a result of that, the changes here have both an effect on obviously the credit file just as it is at this one point in time, but have also an effect on the history. And so as a result, then that's sort of the key driver. So with the history, you expect that to then go up or down differently, and the trends to show different things with VantageScore 4. And so in a nutshell, that time series view means that the data is treated differently. And as a result, you can see some differences in the scores from that.
Got it. Makes sense. Well, thank you. And on behalf of VantageScore, our panel participants and webinar attendees, Patrick, I just wanted to thank you again for joining us, and thank you for the Department of Education's leadership and the innovation that you and your team have displayed these past few months. I know you're incredibly busy executing on all of these things, so thanks again for spending time with us. Feel free to stick around for the panel discussion, or if you need to drop off, that is of course fine too. Thank you very much.
Thanks, everyone.
Okay, so we're going to move on and introduce our credit reporting company panelists. But while I do the introductions, I just wanted to queue up a question for your feedback. I promise you this is the only poll question we'll ask today, but we always strive to measure and improve the quality of our webinars. So if you would kindly fill out this audience feedback poll, we would be very grateful. And once you fill it out, it should disappear. So let me just set the table a little bit for our panel discussion. From a lender's perspective, changes to student loan reporting, to consumer credit scores are incredibly important to understand, really from a holistic level. Secondly, we're in the middle of a turn in the cycle, as we know, where many economists are pointing to a recessionary period. Notwithstanding all those things, the industry has rallied to pursue greater financial inclusion, and we don't want to see the momentum of that movement being in any way affected by some of these changes. And in fact, we would imagine this could be additive. So the good news is there's lots of tools, experts, and resources available to our lender partners to help navigate these waters. So to discuss this, we're going to be joined by 3 subject matter experts along with Ricard. They should be joining us here in a second. I'd like to welcome first Jessica Harmon, Senior Director for Market Strategy and TransUnion's consumer lending business. So Jessica is a Senior Director. She covers personal, student, and retail investment lending. She focuses on market strategy, product development within that business. And prior to that, she was the director of the direct-to-consumer business at TransUnion, where she focused on operations strategy. Jessica, welcome, and thank you for joining.
Thank you.
Next, I'd like to introduce Kathleen Maley. Kathleen serves as Vice President for Analytics at Experian, where she is responsible for defining and launching analytics solutions and delivering those analytics at scale. And interestingly, this includes generic scores, a topic near and dear to our heart, and as well as segment-specific and specialty scores. So she previously served as the Chief Analytics Officer at DataZoom and SVP of Consumer and Digital Analytics at KeyBank. Kathleen, thank you for joining us.
Good to be here. Thank you.
Last but not least, I'm pleased to introduce Tom O'Neill, who serves as Risk Advisor at Equifax, where he brings over 20 years of experience leading analytic consulting engagements within the financial services industry and other industries. And in his role, he provides analytic thought leadership to client senior management at public forums and various industry advisory councils. More than likely, participants in this webinar have been on the other end of some of your other presentations. Interestingly, upon the onset of COVID-19 and the resulting CARES Act, Tom was responsible for producing a weekly market insight that we all watched closely. So Tom, thank you for joining us.
Thank you very much, Jeff. Happy to be here.
So Tom, let's start with you. Let's talk about kind of the macro economic environment. We're obviously in some relatively new territory. Of course, many of us have been through a couple of cycles, but certainly it's been a while since we've seen economic headwinds like we're seeing today. So when we look at the consumer and how they're performing, how do you recommend a lender examines and understands durability as we sort of see some signs of distress continue?
Sure. No, it's quite the topical question. Not that we've seen anything over the last couple of years that would bring any uncertainty into the picture. I should predicate any answer in terms of what else we could bring by addressing a question that I've heard from clients before in terms of the traditional scores that we've used, VantageScore, that they see things over the past couple of years where there's been score migrations. They see average scores changing, going up as some of the effects of the last couple of years take place, and they question should we be adjusting in the way that we use these. And my first point would be absolutely keep those those scores, Vantage scores and the like, are as imperative today as they've always been. They still distinguish risk. They are still a fundamental part of any sound lending strategies. What we would recommend, with what we're seeing today, is then complement those with other insights into that consumer's fuller financial and credit view. So you mentioned financial durability. That's an excellent example where you take that consumer and go beyond just the credit history and the performance from that, and you layer in other elements. As an example, we have a financial durability index that takes that credit history, affluence, spending patterns, income information, and really creates you can create a portrait of that consumer's financial resiliency. How well are they going to handle, times of stress. And that's important because oftentimes, two consumers may look very similar from a simple credit score standpoint and credit performance, but be in very different, life situations where we want to distinguish that and get that fuller picture. So that's one option. And in other areas, you may be looking at things like income verification or debt to income data, or Ricard mentioned trended data around debt to income and other metrics. Those are all very helpful in sort of getting to that fuller picture that is often useful in distinguishing one consumer's risk from another.
Right. I appreciate that insight, Tom. Switching gears a little bit for a moment to Kathleen. So in some cases, student loan borrowers, that student loan account might be the only trade line or account in a consumer's credit file, or it could be one of two, and just all of a sudden, if that account is closed out, there's limited information on a borrower that may have limited access to financial services and credit products anyway. So how do lenders kind of account for this and kind of continue this effort that we've all been focused on in spreading and awareness and driving inclusion?
Absolutely. The financial inclusion is a topic that is near and dear to my heart, and it's actually not dissimilar to what Tom was answering. How do we get a fuller picture of the customer's or the consumer's true credit risk reliability, true credit risk profile? We are in a different place than we even were 5 years ago in terms of the data to which we now have access. Reliable data, reliable FCRA approved data that helps us paint a fuller picture of any individual consumer's profile. And so what that means is, what we talk about traditional credit data, that used to just be credit data. It only became traditional because now we have this other thing, alternative.
Yeah.
For decades, we have given people points on their credit score because they paid their mortgage reliably. We didn't give them points for paying their rent reliably. We didn't give them points for paying their cell phone reliably. So when you're looking at this particular population of new entrants to the credit market, thin file or invisibles, it actually doesn't matter how good our models are. It does, but asterisk, I'm being dramatic. It doesn't matter how good the model is. What matters is whether or not we're actually measuring these individuals on data that will tell us more about their financial reliability than those traditional credit attributes. So it is about painting that fuller picture. It's about using alternative data that paints that fuller picture and brings people in. If I'm not measuring people, it doesn't matter how good my model is. I might get better separation on the people I'm already measuring, but I won't be getting any information about the people I'm not measuring. Data is the foundation of everything that we do.
Yeah. Real quick, I would just add
a theme here.
Yeah, sorry. Just to add real quick to what Kathleen was saying, I love her comment about, it's only become traditional data because we have so much new data available, and that's certainly the case. And I want to say, when people refer to alternative data, I think we've finally gotten to a point where that doesn't have a negative connotation. For a long time, when people thought alternative data, they thought payday lending. They thought, these negative connotations to alternative, but it's so much more than that. It is such a wealth of information by which positive, responsible behavior can be gleaned from how they are being captured within those alternative data sources.
Yeah, and it can always be broadened, and we'll always kind of have more data sources that we can find, and that's the other benefit of alternative data.
So maybe dovetailing on that, Jessica, Patrick described a lot of changes to how these accounts could be reported to consumers' credit files. And for some lenders, they might be saying, well, pump the brakes here. Like, let's understand kind of what the impact to the insight on a consumer's risk might be. How do you sort of equip lenders to ensure they have a clear view of that risk behavior in light of some of these changes and how some of this data might change?
Yeah, so again, we were all talking about alternative data and how that can provide a good visibility and broader viewpoint. But I do want to talk more about credit for this one, right? That is kind of the table stakes here. And what we were talking about in terms of the changes is really not quite different to what was going on at the beginning of the pandemic in 2020. We had a lot of forbearance, and it was not quite blanket forbearance, but you had a mixed bag. Some people who were really in financial duress and some people who were just taking advantage of the opportunity, just as a precautionary thing. So we were hearing from lenders at that point, how do I make sense of all this? Because we're not getting delinquency data like we used to. We're getting kind of reported differently. And we're also handling kind of different payment behavior. How do we make sense of this? And from going through our own analysis at TransUnion, understanding what's kind of the best tool, it's trended data, which came up earlier in the conversation, right? And that was still allowed lenders to stratify risk. And I think just tying it more closely to what we've been talking about with student loans, this came up in the study results that were shown there, talking about the debt forgiveness. You saw that there was kind of that negative impact. And we actually saw this in results that TransUnion did. We did a similar study. We saw a little less any adverse impact that could come from closing out a loan due to debt forgiveness, that is mitigated with trended data, right? Because you're not losing that trade line, you're still going to have that credit mix history there. So I think that is really, in addition to other data to get that fuller picture, trended data is really core and needs to be part of that approach.
Thanks, Jessica. Anything anybody wanted to add on to that? Well,
yes. How much time do we have?
We're just about time, but we covered a lot of ground, and want to just say thank you to our panelists. Also, just want to share the last slide of our presentation here, which is just again, thank you all for your time and your insights. To review the fact sheet that Patrick showed, there'll be a link here. Again, these slides will be shared with you. Some of the analysis that Ricard went over is available on our website through a blog that's linked here. A lot of tremendous resources on VantageScore.com, including 2 new tools we recently introduced, one of which Inclusion 360, quite relevant to today's marketplace, where it'll allow you to, through different time frames, compare the score to risk relationship, which, as we know, is dynamic, and you can do that between different products as well. So if you're just interested in credit card, you can look at the comparisons just in that product category, or mortgage, or whichever category your portfolio has. And of course, Inclusion 360 is a tool that'll allow you to drill into a map of the United States and actually understand how many creditworthy consumers are available in almost at the community level throughout the country. So lots of great stuff on VantageScore.com, in addition to some of the resources on student loans. I'll just close things out. Thank you again, and look forward to our next webinar. Take care.
Thank you.
Thank you.